Hi everyone, welcome to the Finance Research Seminar. I'm Linda, I'm co-organizing the seminar with Julian Körbel, and it's hosted by the Center of Competence for Sustainable Finance. And before we start the talk, a few words about the procedure. Please keep your microphones muted to prevent background noise. If you have a question during the talk, please use the chat. We will have time in the end to take questions, and then you can unmute yourself. We will record the session, and I also want to give you a warm welcome to our speakers, Stacie Wang and Alexander Cheema-Fox from State Street Associates. They will present climate change vulnerability and currency returns. It's a pleasure to have you both here with us, and without further words, I will give the stage to you.
Well, everyone, thank you, Linda. Thank you so much for the kind introduction, and thank you for having us today. So for today's session, Alex and I would like to present our new research, Climate Change Vulnerability and Currency Returns. And this is the new paper Alex and I have co-authored with our academic partner, Harvard Business School professor George Sarafin. There has been increasing amount of interest in research in climate finance and investing. Well, most of them are studying the impact of climate change on equities and foreign exchange instruments in the market. And we find there's relatively few that's looking at currency, climate's impact on currency prices and currency returns in the foreign exchange market. Probably this is not very surprising because when you're talking about foreign exchange rates, its movement, it's affected by many factors. We know there's traditional FX risk factors like carrier momentum value, and also they are affected by macroeconomic fundamentals as well. So the FX and foreign exchange rate is not the first place many people would expect to see the impact from climate change. So in our new paper, we are applying these climate change fundamentals, particularly the physical risk from climate change, to the FX instruments and building currency portfolios. So to the best of our knowledge, we think this is the first among the first analysis that have established the linkage between physical risk from climate change and currency returns. Particularly, we find that the climate change vulnerability could help to predict future currency returns. If we move to the next slide, our plan today is to outline first the challenges and also the key characteristics of climate change. Then we're talking about how the physical risk from climate change is something that is actually measurable, and also something that has very special characteristic, that is that it depends on the locations. And then next, we examine the relationship between climate change vulnerability and the existing most studied economic fundamentals. What's the relationship there? Then we construct, we demonstrate how we build climate resilient portfolios, how investors can achieve that with currencies in foreign exchange market. And lastly, what is the relationship between climate change, climate risk, vulnerability, and currency returns? What have we learned from our currency portfolios based on historical data? Before I dive into the details of our methodology and our results, I first want to spend a little time on why climate change is the ultimate long-term investing challenge. So there are from three perspectives. So the first is that there is a very long lag between our actions today and their impacts on our environment. The reason is that CO2 and a lot of the greenhouse gas emissions are very long time lasting emissions in our atmosphere. Many people don't appreciate that. Even if we completely stop our activities today, stop all the carbon emissions, we will still continue to experience these impacts. So they are already locked in. So in terms of, we'll continue to experience the droughts, the wildfires, hurricanes, and also extreme weather patterns and rise of sea levels. So there is a long lag between actions and the impacts, and then we need to take actions immediately and right now. And on the right-hand side, you can see there is a figure shows the relationship between the CO2 emissions and temperature. This is based on the IPCC's most recent 2021 climate change report. You can see that there is a linear, very clear linear relationship there. So every ton of CO2 emissions adds to global warming. And the second point is that there is very large level of uncertainties of outcomes that we are likely to experience in the future. According to climate scientists, there are a wide variety of different climate models and outcomes. Because these models are very complicated, there are a lot of components goes into it. So in terms of outcomes, it can range from moderate to severe and extreme severe effects we can experience in the future. And also the distribution of these outcomes can be very uneven across different geographies. If you compare the Southeast Asia to Europe to South America, Latin America, all these risks will be manifested very differently. And even within the European Union and within the US, they can vary across different areas and regions. And the third area reflects the challenge is that there is a global collective action problem. So fundamentally, all countries, nations need to work on this together to tackle climate change. So we need global coordination and collaboration, but it's very challenging for us to agree on every aspect of climate policy because different countries have different endowments, they have different resources, and also histories, and also technological developments. Actually, in April this year, we have reached another record high level of CO2 emissions in our atmosphere, about 421 parts per million. So this stark new level of CO2 emissions, it's a warning to us that although we have already started to take actions, we're still very far from having this greenhouse gas effects under control. Moving on to the next slide, I want to show you that in terms of strategic relevance of climate change, respect to risk and opportunities, there are mainly two aspects. One is transition risk, and the other is the physical risk. Transition risk happens when our society are moving to a low carbon economy. So, for example, we have seen increasing climate-related regulations and increasing carbon tax, and also evolving taxonomies on climate change. While transition risk can also happen when we see technological advances in renewable energies and also in climate solutions. For example, we've seen more climate-based food companies out there too. So this transition process can affect the demand and supply of the economy, affect the cost of goods and productions, the top and bottom line, and therefore affecting the company's evaluation in the financial markets. So we have recently published 2 papers on portfolio decarbonization and have quite interesting findings. If you are interested, I'm happy to share this paper too. So, but for today, we want to focus on the other aspect of climate change, and this is from the physical risk perspective. So physical risk happens, arises with extreme climate events such as storms, flooding, wildfires, or extreme cold or hot weathers, or rise of sea levels. So some events can happen really fast and have immediate impacts and damaging the infrastructure, the factories, for example, and also disrupting production, the supply chain, and transportation distributions of business. While some of these events can have very long-term lasting impacts, such as rise of sea level and changing weather patterns. So these physical impacts can have huge social and economic losses. And also one characteristic about the physical risk is that it could be very location specific. meaning that the probability of that happening and severity can vary a lot depending on the geographic area you're in. What we have seen in the data, and also based on anecdotal evidence, we've heard more news on talking about natural disasters. And based on data, yes, we have observed that natural disasters are happening more frequent and more severe and associated with greater social economic losses in the past few decades. So on the left, we have a figure showing the number of global climate related disasters from 1980 to 2018. This is by different types of events. You can see there's storms and flooding and drought, wildfires in here. There could be fluctuations from year to year. There are some years have dramatically more events happening, but the overall trend here is very clear. We are experiencing more climate-related disasters and hazards over time globally. And on the right-hand side, we have some examples of extreme climate events and their social economic impacts. This is based on the McKinsey report we're citing here. You probably remember seeing a lot of them in the news, like the Hurricane Harvey, the Hurricane Sandy, and the heat wave happened in 2019 in Europe in 2019, but also this year too. So these events are associated with huge social and economic losses. And scientists also find that in each case, climate change has either intensified these natural disasters or increased its likelihood. For example, there is a flooding happened in Hunan province in 2017, and this flooding affected over 7.8 million people and cost over 3.5 billions of direct economic losses, including severe infrastructure damage in the local area. And it is estimated that climate change has increased the likelihood of the flooding happening in this local area to twice as likely as before. So these examples and also these stats is telling us that physical risk, it's real, is already impacting on physical, natural, and human capitals. If we continue business as usual, going on about 3 to 4 degree, we'll be on the path to 3 to 4 degree warming scenario. We expect these impacts to accelerate in the next few decades. So in order to study this impact from physical risk, so we first need to quantify it. And luckily, researchers and scientists from the Notre Dame Global Adaptation Initiative have already done this. So we are using the climate vulnerability scores from NDGN to study the physical risk. To calculate a country's climate vulnerability score, NDGN evaluates each country from 3 components, including the exposure, the sensitivity, and adaptive capacity. And they collect the data and variables from 6 life supporting sectors, including food, water, health, ecosystem services, human habitat, and infrastructure. So the 3 components are equally important. For exposure, think about the potential for a disaster to strike a region due to geographic locations. For example, coastal areas have greater risk because they are more likely to be impacted by tsunamis or hurricanes, and also subject to the rise of sea level. For sensitivity, think about how would a disaster affect a region once it happens. For example, think about how much does a country's food or energy sector depends on imports and exports. And once a disaster happens, how much would that affect these sectors? And for adaptive capacity, think about how well a country is able to mitigate and recover from these negative shocks once it happens. We can use Japan as an example here. So Japan has relatively high exposure and sensitivity to physical risk because Japan has very complex coastlines, so it's more likely to be impacted by tsunamis and rise of sea level. But Japan, on the other hand, is one of the most developed countries and it has better infrastructure. So Japan's more prepared for natural disasters, and once it happens, they can quickly pull their resources to help it to mitigate and recover from these negative shocks. So combining the three components, Japan has relatively moderate climate vulnerability. On the right-hand side here, we have a graph, a map showing the climate vulnerability score. This is a snapshot for 2018. As you can see here, the different physical risks are colored differently. So the redder they are, the higher the risk. You can see that the physical risk is really location specific, and it varies across regions and countries. So moving on to the next slide here, I want to show you the climate vulnerability, the levels, how do they look like, and also the trend for the G10 and EM countries in our sample from 1995 to 2018. The climate vulnerability score here ranges from 0 to 1. So the higher the number, the riskier they are. We have several important observations here. So first is that EM economies are in general more vulnerable than the G10 economies, which is probably not surprising to many people. As I mentioned, there are three components goes into modeling the climate vulnerability score, and adaptive capacity is one of that. So G10 countries are less vulnerable than EM. It's not very surprising. So in G10s, Norway and Switzerland have the lowest vulnerability, while Japan has the highest vulnerability. And we see that G10 countries' vulnerability are generally going down over the years, but the change is relatively small, except for New Zealand and Switzerland. Oh, sorry, New Zealand and Australia. And for EMs, yes, they have higher climate vulnerability, greater physical risk, but we also observe that there are greater variations across countries and greater variations over time. So among the EMs, we see some countries with substantially higher physical risk, for example, the Malaysia, Indonesia, and India. Well, on the other hand, there are countries that have very similar level of risk as to the G10 countries, for example, Russia, Poland, Czech Republic. Also for EMs, we observed that the downward trend is more noticeable. Particularly Turkey, Peru, for example, had more than 8% reduction over the past 3 decades. So overall, EMs are more vulnerable than G10s, but the gap between EM and G10s, EM and DM has been shrinking over the years. In addition to these, we have 2 more interesting observations. One is that so the climate vulnerability score seems to be correlated with the economic activities, economic development. But when we look at the ranking based on climate vulnerability, it can be very different from the ranking based on economic development, such as GDP per capita. Using 3 countries as example, so think about the US and also Turkey and Russia. So US is much higher GDP per capita than Turkey and Russia, but the 3 countries actually have very similar level of physical risk and vulnerability, particularly in the most recent years. And lastly, climate vulnerability shouldn't be confused with geopolitical risk. Using this example again, Turkey and Russia have high geopolitical risk, but their climate vulnerability is not particularly high. They only have moderate to lower physical risk. I hope these examples make sense and help to understand the metric, the measure we're using for this study. And next, Alex will talk about how we link this physical risk to the currency returns, currency prices, and what's our hypothesis.
Thanks, Stacie. All right, so right now we've picked our measure of risk. So we have a way of assigning some score to a given country, determining how vulnerable that particular country is climate risk. All right, well, how do we get from there to an FX value, to an exchange rate? Well, our idea is that if there's one way to buy and sell a country, it's through the foreign exchange market. So if you think of the FX market as the most direct way to trade a country's economy, whenever you want to invest in a given country's assets, whether it's equities or whether it's bonds or whether it's real estate, at some point in time, you have to pass through the FX market to do so. So we are going to accept that proposition that if you want to buy and sell a country, ultimately you need to deal with the FX market. And within the tradition of FX models, there is a very long and venerable tradition of things called present value models. These go back decades, and they basically describe the exchange rate as a function of current and future macroeconomic fundamentals. So, the bones of the economy and how those evolve through time. You can think of this, if you're more used to equities, as sort of the FX analog of a discount dividend model. Now, furthermore, it has been demonstrated by others. In particular, there is a paper by Dahlquist and Hasselhoff from a year or two ago that trends in economic fundamentals do ultimately drive demands for assets of a country and predict currency returns. So we're positing that the connection is this, that the impact of natural disasters on an economy, so the natural disasters hit macroeconomic fundamentals. Those macroeconomic fundamentals then are evidenced in changes to the exchange rate. So the connection is through climate vulnerability, tells you about disaster risk. Disaster risk is effectively something that ought to eventually be priced in the foreign exchange market. And that's the grand arc of our research in this particular case. Now, as we think about this a little bit more, we have noted that particularly in countries that lack deep and liquid access to insurance markets, the impact of climate disasters can be a lot more severe to the local economy. They don't have shock absorbers. They don't have the cushion of a nice, lovely insurance, or given that you're in Switzerland, reinsurance industry. These things are not accessible to everyone everywhere. So for these countries in particular, beyond the obvious direct damage that is inflicted upon the infrastructure and upon the humanity living in those countries, things like productivity can also be severely impacted going forward, because given the lack of an insurance channel, the ability to recover from disasters can be a lot lower. And that tends to mean that it's harder for that sort of country to invest in its human capital to repair its infrastructure. So taken together, in these sorts of scenarios, we would expect the effect of a disaster on a country's trade balance and the value of its assets to actually be rather severe. And we have found in our research that levels of vulnerability directly do relate to economic fundamentals. And we also looked at changes in vulnerability, which we also find can connect to and affect economic fundamentals. And ultimately, the circle does seem to be completed when we conduct portfolio tests, and that there does seem to be a linkage from the changes and levels of climate risk vulnerability ultimately to currency returns, part of which is not fully explained by movements and levels in the macroeconomic fundamentals themselves. That's sort of the sketch of what we're going to discuss here. So the basic story, just to recap it because it's important, we're really viewing this as all proceeding through a macroeconomic channel. So climate vulnerability, climate risk, which Notre Dame has measured reasonably well, we think, impacts the macroeconomy, the macroeconomic inputs and effects are eventually reflected in the exchange rate. And the way to conversely trade those effects is by trading the exchange rate, trading the currencies. All right. Now, as a quick aside, before we go into things like returns and all that, we did want to understand, well, is there a linkage between what we're observing, between these levels of risk and actual outcomes in terms of human damage and in terms of economic damage? So to sort of concretize this, we conducted a simple set of regressions. What we did is we regressed observed economic losses as a percentage of GDP on, as well as the percentage of the population that is actually affected by natural disasters on these levels of vulnerability that we've obtained from Notre Dame GAIN. Now, these disaster data, they come from a source called the EMDAT database. So this is essentially sort of an insurance-inflected database that tracks the economic impacts and the human impacts of disasters going back about 20 or 30 years. So we utilize this database And we were able to run this regression across something, this is about 500 odd observations of disasters of sufficient severity to be reported, and to understand how these disasters were related in terms of separately in terms of their human and economic impact to the levels of vulnerability that we observed from Notre Dame gain. Running this regression, we did find, as you can see in the statistics over here, which are quite significant, at least statistically, we did find that there is a positive relationship, whether we're looking at human damage or economic damage, between the level of vulnerability and the ultimate impacts of disasters that occur. So these risk measures from gain do seem to be sort of understanding the arrival process of disasters and events. So they seem to be a good risk measure in that particular way. This serves as a validation of them. And of course, those disasters have the unfortunate impacts they do on the populations and economies affected. We didn't find the sort of the magnitude of the coefficients as large as we might have expected. As you can see, these aren't gigantic coefficients, the significance as they may be. So we posit that there might be some reporting issues. Some of the most severe events may be underreported or undermeasured. But even given that potential caveat, there does seem to be a clear relationship at any rate between these measures of vulnerability and fundamental macroeconomic and simple human suffering outcomes. All right, now, if there's to be any point at all in looking at these new measures of climate risk and ultimately connecting to the exchange rate, there'd have to be some component of them that is independent of macroeconomic fundamentals. If the Notre Dame gain measure is ultimately some sort of linear combination of things lying around anyway, there's not going to be a lot of interesting research to be done. So we had to establish that there's some component of these measures that is not simply subsumed by your standard workhorse sets of macroeconomic factors. So in order to do this, we do what folks do, we ran another regression. Now in this case, we are trying to regress the observed levels, that's the regression on the left, and on the right, we also look at changes, this is based on a 5-year change in the measures, on standard macroeconomic stock variables and their flow analogs. So in some cases, the usual variables say current account as a flow, so we've constructed a sort of stock analog by accumulating that, and in others, vice versa, something like debt to GDP, well, it's sort of a stock and a flow, depending on how you think of it, but we would difference measures like that and run that difference as a regressor in a regression to try to explain the changes in the gain measure. So when we conducted this regression, we assembled many of the usual suspects. Perhaps your favorite measure isn't in here, but many of the measures are in this particular set, things like GDP per capita, price level and inflation, the current account, debt to GDP to give a sense of indebtedness and fragility, unemployment to speak to the labor market, industrial production and retail sales to speak to the factory and the consumer, essentially. Now, these last two variables weren't available everywhere and always in our sample. So we actually ran a separate regression with them kicked out just to make sure that there weren't any sample selection effects biasing our estimate. We get pretty similar answers with or without them. So we conduct each of these regressions, one in levels, one in deltas. And I'll also point out that in the deltas regression, we do also include one sort of rogue level in there, log GDP per capita. That's meant to help discriminate between the rich and the poor, or the EM and the DM countries. Because as Stacie showed you several slides ago, there is a huge difference in the average level of vulnerability between these two. So we wanted something to speak to that, and log GDP per capita was our sort of deputized proxy in that regard. But the main outcome from all of this is that a great deal of the variation in the level of vulnerability is in fact subsumed by standard macroeconomic variables. We have R-squareds of around 75–80%. But when we look at the changes in vulnerability, what we're going to end up calling vulnerability momentum, there we see that while a reasonable proportion of this, the variation in vulnerability changes is explained by the macroeconomic variables, far, far less. So here we're looking at numbers sub 30%. So for that reason, as we proceed forward in this study, we've actually focused more on these changes in vulnerability, which in this case, the 5-year changes, aka vulnerability momentum, and looking at how those could explain currency returns, because we thought that this is a bit more independent of the standard macroeconomic variables, and thus the changes may be a bit more interesting. And they might, by the way, also be, they give you a sense of what is perhaps not yet priced. You're sort of seeing changes, you're seeing trends emerge those may or may not yet be priced by the market, whereas the current levels of vulnerability are probably pretty observable, better understood, and maybe more likely to already be priced and understood by the currency market. I'll also point out that in this case, we're not simply using an annual change in vulnerability. We're using this sort of 5-year trend. There are a few reasons for this. One is just a matter of noise. The vulnerability measures are themselves annual measures. There's a little bit of noise in them, and if we're measuring them every year, we did find that those relationships were a bit noisier than after incorporating a bit of smoothing. These are also, remember, very long-term effects, as Stacie pointed out, that are being priced. So year-on-year variation, just like people might not react substantially to a given macroeconomic print, and they might wait till 2 or 3 of them line up. Here, the macroeconomic print is annual, so we're sort of applying the same concept that perhaps people need to observe a bit of a trend, a bit of a consistent pattern before actually reacting to this kind of information. And finally, the 5-year window is also reasonably similar to what Dahlquist and Hasseltoft ended up using when they were looking at their own evolution of macroeconomic fundamentals to construct their factors, which ended up being quite useful for them. All right, so sort of back to the original idea. We wanted to connect the foreign exchange market to these measures of physical climate vulnerability risk. Well, one standard way to do that is through a set of portfolio tests. Okay, so in order to conduct these portfolio tests, what do we really care about? What are we trying to trade ultimately? Well, all right, anytime you trade foreign exchange, you're buying one thing and selling something else. I mean, that's true if you're buying equities or whatever, but usually there's a common numerator of cash versus everything else. In this case, every trade is making it very explicitly that you're exchanging one numeraire for another. So to us, what mattered here were the relative changes. So really sort of the relative vulnerability momentum measures. So what we tended to do here is for each currency pair that we could identify, there's a sort of hierarchy of relative vulnerability. So in any given currency pair, we would buy the currency that is experiencing decreasing vulnerability, the idea that ought to ultimately presage good macroeconomic outcomes, and we would short the currency with increasing vulnerability. And we would conduct that for any given pair trade. So you can think of this portfolio is basically a set of pair trades. In each case, we're buying one currency and selling another currency. And in this case, we're using 1-year forwards to do all of our trades. And we're choosing where to go long and where to go short based upon the relative vulnerability momentum. That's a lot of words, but really it just means who's doing better than who in any given set of currency pairs. So we have a set of buys and sells using these 1-year forwards. And then we simply choose to take a set of these cross trades and look at their returns. And we're weighting our portfolios fairly simply. We're equally weighting across all the pairs, and we're building out all the possible combinations across all the currencies that we're examining. So we start with a set of fairly standard, fairly liquid G10 emerging market pairs and the Singapore dollar, which we're classifying as non-G10. We construct all the crosses. So you end up with 406 possible answers. From each one of those at each instant in time, or each year, which is an instant to us, we have a set of trades that we put on, and we monitor the progress of that portfolio through time. It's rebalanced annually, so it's moving at a snail's pace in the context of FX. We've subdivided this a bit more as well. So we looked at the global sample, which would include all crosses. So some of these would be EM, some would be G10, say dollar Swiss. Some of these would also be EM, say Brazil Mex, which in practice would probably proceed through the dollar. But we know that there are very different characteristics in terms of the climate risk vulnerability amongst these different sets of economies. So when we conducted our analysis, yes, we did a global analysis, and that would mix everything together. But we also did proceed to look at particular subgroups. So we looked at cases where both legs of the trade were within G10. Those are our G10 only pairs. We looked at particular cases where one leg of the trade is in G10 and one leg is in non-G10. And these are basically going to be things like dollar, say dollar Brazil, or say, let's say Singapore dollar yen, things of that nature. And there you're it's sort of a risk trade. One leg is relatively low risk and one leg is relatively high risk. And then we also just looked within EM at what we're calling the non-G10 pairs. So things like Brazil Mex would qualify there. to understand what subpopulations are really driving the overall result. And all of these tests were conducted over the range of dates available to us at the time, which are basically from 2002 to 2019, the limiting reagent here being the Notre Dame gain data, which are quite lagged. We were operating here with, I believe, a 1-year lag. Results are fairly robust if we went up to 2 or more years, actually. So that it doesn't, given everything is so slow moving, there's not a huge problem with the publication lag, luckily. All right. So just to take a look at some of these actual results. So this is what we obtain when we utilize these various delta measures and form portfolios and track their results through time. Now here we're looking at a number of things. On the left, we're looking at cumulative portfolio returns. And by the way, there's also a step here where we stratify. We don't need to use every single pair in forming a portfolio. We can ignore the pairs where there's very little difference in relative vulnerability. So we can take the top half, for instance, or if you like, stratify further, of pairs just by the gaps, by the variation effectively between the two legs of the pair. So you can imagine a case where technically if there's a difference in relative vulnerability, but it's essentially noise, you wouldn't necessarily expect there to be much of a change in macroeconomic outcomes, and you certainly wouldn't necessarily expect that to filter through to the currency market. Now, in this particular configuration, we are examining 3 different strategies on the left. One is looking at the change in vulnerability itself. And that's the composite measure that Stacie described before that combines sensitivity, adaptive capacity, and exposure. But we're also looking at 2 of the subcomponents of vulnerability, with the notable omission of exposure because exposure never changed. So the exposure portfolio would be flat because the delta of exposure is always 0, at least in this 20-odd year sample that we have on hand. But both sensitivity and adaptive capacity did seem to change through time. So here we examine using those characteristics as subcomponents of vulnerability to sort and form portfolios. And looking at this result, a few things stand out. One, there certainly is on average a sort of positive return to this kind of strategy. The lines go up, and that's nice for us, I suppose. It's also true that these are statistically significant when you regress this vector of returns on a number of standard factors. So we controlled for carry, we controlled for value, we controlled for momentum, we controlled for a dollar factor. We ran this regression, and there's something risk adjusted in all this too. And that's indicated by the alpha statistic over here with 3 happy stars indicating a great deal of statistical significance in the T statistic. So that's one thing that we see from all this. There does ultimately seem to be something evidenced in actual returns by utilizing changes in climate risk vulnerability across a broad selection of currency markets. So there does seem to be something that ultimately connects to actual prices in the foreign exchange market. But when we sliced and diced this a bit, we did also find that a lot of this effect really seems to be driven by the changes in sensitivity rather than by the changes in adaptive capacity. So changes in adaptive capacity also on average earn a sort of premium, but it's a much, much less robust premium. And in fact, if we look at sensitivity alone, we see something that is a bit of a stronger performer than vulnerability, the aggregate measure itself. So that indicates there may be value to disentangling these components to understand what is priced and understood, what is varying more and less in these various economies, and hence what may translate to the foreign exchange market ultimately. As a bit of quality assurance, and to give you a sense of the characteristics of this aggregate portfolio, we also tried to net things out to the individual currency level. Because remember, we have a whole set of pairs, but when you integrate across the set of pairs, that implies a net position or a typical long or short position in each of the individual currencies. So to give you a sense of the degree to which we're really tilted towards single currency trades, we characterized one, the average weight in the portfolio. Now remember, this is long short, so the weights could be between minus 100% and 100%. But as well as just the proportion of time that a given currency was long or short. When we look at this in the chart on the right, we see there is certainly substantial variation. I mean, there are some currencies that are generally speaking long or generally speaking short. There are some biases, but on average, most currencies experience some amount of time long and some amount of time short. There are a few exceptions to this, things that are generally speaking long or short. But we do see reasonable cycling through of the currencies in our portfolios. This doesn't appear to be a static bet on particular currencies. All right, and just to conclude this little component on performance, when we examine disentangling this overall result into subgroups of currencies, we did find that outside of G10, in the emerging markets, if you will, the portfolio results, and this is reverting to vulnerability itself, not the subcomponents, were much, much more potent in the emerging markets than in the developed markets. In fact, if you limit to the G10 crosses, the gray line at the bottom, there's basically nothing there. And that's not entirely shocking. There's much less ultimate risk to climate effects in the developed markets. So of course, we know there is a lot of exposure, but compared to emerging markets, this is far, far lower within developed markets. Whereas, and this might be a bit surprising, when we look at emerging markets alone, so these are EM crosses, where both legs of the trade are in emerging markets. There we actually found not only the strongest returns, but also, as you may recall from the slide that Stacie showed a few minutes ago, that's where the spread is also greater. So yes, the average level of risk in emerging markets is higher, but there have been trends and change, so there are bigger deltas, and there's a great deal of spread amongst emerging markets. So all of that seems to connect to the trade on climate vulnerability risk, effectively speaking to macroeconomic fundamentals within emerging markets, is where the most potent effects are to be observed. There is some effect when we combine EM and DM currencies. There was relatively little effect when we look at developed markets alone. And in fact, developed markets alone are the case where if we look at the statistics after the usual risk progression, we find there's really nothing left over. So this positive line, unsurprisingly, is totally subsumed when you account for risk. And that concludes a sort of basic view of some of these portfolio tests. I'm going to toss it back to Stacie to explore this a little more.
Thank you, Alex. I think to be conscious of time, I'll maybe to summarize this are the three next slides, because in these three slides we're kind of did more testing, really trying to understand our strategy and this measure of vulnerability momentum. So one thing we did here is that, as Alex mentioned, so why do we observe there's difference between the G10 currencies and EM currencies? So one possible explanation why it works better for the EM currencies is because for most G10 currencies in our sample, we don't see meaningful really change in their climate vulnerabilities in our sample period. And on the left-hand side, we have a scatter plot. As you can see that we're showing the excess returns versus this pairwise differentials in our measure of vulnerability momentum. And you can see that the G10, the pairs, the portfolios with the G10 pairs have on average smaller spread and also lower returns than the portfolios with non-G10 currencies in them. And on the right side, we stratify it by different pairwise differentials, and then we see that as the spread widens, there's almost a monotonic, monotonic increase in the portfolio returns here, which is the green bars. While the risk increases as well, and we observe that the Sharpe ratio maxed out around 50%. And then the next slide, we examine the relationship with macro factors. So how does our strategy relate to strategies based on macro variables? Is really additional information in our measure climate vulnerability regarding to currency returns, which are not already included in these macroeconomic fundamentals. We have three models here. For across all the three models, we're regressing the portfolio excess returns and on these set of variables. In model 1, we are only regressing on these macro portfolio returns. In model 2, we're only regressing on the traditional FX risk factors. And in model 3, we are regressing on both the FX risk factors and also these set of macroeconomic fundamental portfolios. As you can see that in model 3, when we're controlling for all of them, we're still generate sizable alpha, which is statistically significant as to model 1 and the model 2. So these tests suggest that the past information, the past trend of climate variability does contain some information about future currency returns. And lastly, show you very quickly about double sorting results, where we sort on both the level vulnerability and also the trend. So we have been focused on the trend for most of this presentation. Well, here we bring back the level. So we have 4 portfolios, and we observe that the portfolio with high vulnerability but decreasing vulnerability generates the most salient returns, as you can see here, which is the orange group here, about 198 basis points annually. So we do find that the trend seems to matter more for future returns than the level. But the level does seem to provide some information here. So if you are improving from more risky base, the orange group here, you are more rewarded than improving from a less risky base, which is the purple group here, represent a portfolio with low vulnerability and decreasing vulnerability. I'll pass it back to Alex to summarize our main findings here.
Yeah, thank you so much for staying with us. I know it's been a lot of talking, but just to recap what we've said in the past hour or so, that one, which I think a proposition that I think most of you will accept, is that physical risk is real, climate change is happening, and important for us in this particular application, the climate risk is localized. It happens to a place, and countries are places. This is not identical to how transition risk operates. Transition risk can often affect companies, and companies can be internationalized. So this is why we have focused in this particular case in understanding currencies largely on the more localized version of physical risk. We saw, utilizing the data from Notre Dame Gain, that emerging markets generally, have much more exposure to climate risk, though they have been trending downwards actually in this overall measure of vulnerability through time, and converging a bit towards developed markets, which generally have lower levels. We also found that the levels of vulnerability as scored by Notre Dame Gain are pretty much subsumed, or to a significant degree it's subsumed, by standard macroeconomic variables. But changes in vulnerability, which we call vulnerability momentum, are not greatly subsumed by changes in standard macroeconomic variables. Hence, we utilize this finding to exploit the measure of climate vulnerability momentum and see if that could connect via a macroeconomic channel to future currency returns, and did find that this does manifest as an effect primarily in emerging markets, where the spreads of vulnerability are low. In developed markets, there's not much of an effect. But where the spreads in vulnerability are high within emerging markets, there were some substantial effects that actually manifested themselves in an actual strategy formed by sorting currencies, buying some and selling others on a relatively long horizon for currency trading of 1 year. So to finally conclude, as far as we're aware, this is the first actual study that's provided much evidence that the currency market can really be connected to climate risks of a physical sort, and potentially as a vehicle for trading these sorts of risks, or at least one possible vehicle for that. And that concludes our talk. It's over. I think it's over slide. Yes, there it is. And now I'll pass it to Linda and Julian to handle questions, however that goes here.
Thank you very much, Alexander and Stacie. Great presentation. Thank you for your insights. Yeah, I want just to open the floor for questions from the audience. You can unmute yourself and ask questions to the presenters.
Can I start?
Sure.
Okay. First of all, thank you very much for the presentation. I'm being curious on the one slide. So if you maybe can go back to this level and change regressions from different macroeconomic. Yeah, exactly. Yes, here. And in the paper, you also write that you find basically here the negative correlation or negative effect between vulnerability and unemployment. So if I understand correctly, it means that the lower levels of unemployment, the higher the vulnerability. Is there any narrative for that?
Yeah, I mean, that is one of the weirder ones that come out, and there, I don't think we really did have a great narrative for that. I mean, Stacie, I don't know if you remember anything better. I think we kind of put it down to correlation between the macroeconomic variables themselves. I don't know if we ran a univariate correlation in this case with unemployment. I don't remember, Stacie.
Yeah, I don't remember it like with the univariate. We didn't run univariate correlations, but because the employment rate and the GDP per capita has high correlations here, and so I think that's one of the reasons that's causing it to be negative in this example here.
And this is also an overall.
It's not very kind of intuitive, right?
Yeah, it's definitely weird, and I don't remember how many subsets we ran on this. I mean, there obviously aren't a huge number of observations here, though. I don't recall whether or not it was based upon some smaller subset of events. I mean, part of this might have to do with the more developed economies having very strong crisis responses to things like the GFC. That may enter into this a bit, but we never quite disentangled it.
Okay, thank you.
Question.
Any other questions from the audience?
Well, if not right now, I'd have one. Thanks both for the presentation. I was wondering, in the beginning, you showed a slide sort of with red and green countries, that world map. And I was just wondering how sort of, yeah, right, any of the currencies of those red and orange countries included in your sample, sort of the one, the countries where we expect climate physical risks to be most extreme?
So India, yes.
Okay.
I mean, we're trying to
Malaysia, Indonesia,
Malaysia, right?
these countries that
Right.
I
Haven't
think
got
so,
television. Yeah, but yeah, India, Malaysia, Indo. I mean, those are liquid currencies, so there's not going to be anything basically odd going on with that data. And they're definitely exposed. I mean, obviously, a lot of the African countries, they're not as liquid in currency markets, so there's a lot of red over here. But other than South Africa, I don't think any of these ended up.
Even like Singapore, like
it's hard to see from here, but
high. They're right.
Yeah.
They're like,
there it is. It's that little dot. But so yes, in part, though, obviously a lot of the red was excluded, the darkest red.
Right. Yeah. Well, I mean, I understand the data limitation, but that would, of course, be interesting.
Right.
And then another question. So what's mapped here is the aggregate vulnerability index that consists of exposure and adaptive capacity. But then I think you mentioned that exposure is pretty flat. So at the end of the day, what's in the analysis is the change to the other factors, like
yes.
Yeah. Right. So.
Yes,
I mean, exposure does enter into this regression with the weird unemployment loading. It does enter here because it's like a fixed effect for each country. There's just an exposure. It's assigned based on where you are, and I don't know if it's true till the end of time, but on a non-geologic scale, it's basically fixed.
I think it's yes, a lot of the variations are driven by the sensitivity and adaptive capacity. But I do think that it is. I think it's one of the data's limitation that the exposure it's right now fixed for each country. I think they should allow exposure to change, as I also mentioned at the beginning, that we are experiencing more of these climate events. So if you think even from the exposure perspective, even your geographical locations not changed, but over time, for example, the water level is rising. So I still think the exposure, they should allow the exposure to change with time as well. So this is one of the data, I think, limitations for this to the end game vulnerability.
Absolutely. Because if you think of exposure as sort of, imagine disasters are a Poisson process with their arrival probability. It's basically that arrival intensity, right? and we had another almost hurricane in Boston, and I don't think, you know, that's maybe 2 in a decade. It's not supposed to happen here, right? But it does. And I'm from Houston originally. We've had a whole lot of hurricanes, even more than usual. So these arrival intensities are definitely going up, and I agree with Stacie. I mean, logically, that the notion of exposure is truly fixed is not really reasonable. I think it ought to be slowly varying, but you know, it ought to change in a decade. I think that's reasonable at this point.
Maybe a little bit related question. Is it that you maybe thought about other measures of vulnerability or physical risks you could put in the place of the Notre Dame data set, that kind of a robustness check, because we see that sometimes these measures are different from different sources? Did you thought about something like that?
In principle, yes. I just don't know that we've come across any good substitutes.
But Alex, I do want to that we did test it with the economic loss data, right? So that's from the EM debt. So that's kind of validating what we are seeing in the GAIN data. But the one is the indicate data is it's the long-term trend showing the long-term value, as well. The EM debt data is the actual losses from the disasters, which is the post of these disasters, natural disasters, which we did use as to one data source to validate. Yeah, it's shown here. But it's a good point that this data set could be complemented, supplemented with other data source, but we haven't looked into. We looked at a few before, and we decided to use this data set. That's potentially for the future, yes, research, we could look more into that.
Any other questions from the audience?
Yeah, I have one question.
Sure.
To Alex and Stacie. So it's a more general question on this whole literature and on your contribution. I saw you embed your paper, also linking it to the paper of Fari and Gabet on rare disasters and exchange rates. So they basically create a model of exchange rates. What I don't understand is, why did you choose portfolio? They look at rare disasters and the impact on exchange rates, and you look at long-short portfolios over 17 years. When you look at the graph, it looks like a bull market. So basically, what one can read out of it is okay, investors. How to interpret it from an investor narrative. Investors over the long term price it in, and therefore currency pairs, basically, well, you should short currencies that are vulnerable to climate risk, right? But isn't it interesting to see, this whole attention to physical risk is something quite new. In 2002, no one spoke about this. Right? So if we look at, for example, Davos, the World Economic Forum, the top 5 risks that I think it's insurance companies rate or rank, then climate risks have been in 2020 the first time the 5 top risks. They've increased over a few years. So my question is, have you also looked at how this has changed more recently? The impact on currencies in the last, 4 or 5 years after disasters, because looking at the long term, to be honest, I'm a bit skeptical, because it's just a long short portfolio, and then it's just, well, you short some countries, you go long other countries, and then, well, we saw the map. You have quite a resemblance to economic fundamentals, so it's I don't see the real impact of short-term climate effects, right?
Yeah, so the idea is it's meant to proceed through an impact on fundamentals, and the idea is that if forecasts of fundamentals perfectly incorporated an understanding of physical risk, there wouldn't be much to anticipate, and there wouldn't be anything incremental from these measures, right? They would be baked into expectations of future fundamentals that would be baked into the exchange rate. So you're correct in that it may well be true that this sort of premium to be earned fades away as the information processing gets better, as people properly anticipate the effect of these risks on the economic fundamentals and then bake that into the exchange rate ahead of time. Yeah, and yes, like over our sample, we have seen it's been fairly consistent, though obviously there's not a lot of data yet. But this effect didn't peter away in say 2016 versus let's say the previous few years. So far it's reasonably sustained, and this is reasonably robust to us stratifying between the cases with bigger spreads and smaller spreads. The shape of the curve keeps looking the same. But yes, with this, as within many of these studies, including other ones that we've done, that try to utilize measures of climate risk that we think were not fully understood, much of the alpha earned is implicitly predicated on an imperfect understanding and measurement of these features. So we ought to expect, I mean, this is from a theoretical basis. I don't have data to back it up because there hasn't really been the data yet. But one would expect that as these risks become more understood, like many things, alpha turns into beta. And then there will not be an anticipatory premium to be earned because it'll be baked into the fundamentals that everyone looks at anyway. So that is likely what will happen at some point in the future, though it may not be there yet. Stacie, I don't know if you have anything to add as well.
So I'm saying, so maybe about why we're choosing the portfolio setting. So we, the paper you mentioned about the Fari that paper, it's more from a theoretical framework. And while we're building this, we're also thinking about how would actually investors do in this market if this is rising. There's a type of rising risk out there. How could investors build a portfolio really to mitigate this type of risk going forward? And that's why we're building a long short portfolio. And you mentioned about there is a bull market in the past 7 years, but because we're using currencies and it's always a long short portfolio, so I don't think so the bull market has a huge impact on this portfolio performance in the currency markets.
And there's also a component here of anticipation versus impact, right? So here we're using these risk measures because we think they ought to anticipate disasters happening. That's different from a focus on, given a disaster happens, what's the reaction, and how is that price or overpriced into future anticipation? We didn't fully explore those dynamics. I mean, there's a rich literature on ideas like that. The idea that S&P 500 index puts are secularly expensive because of 1987, that sort of thing. We didn't go that far. And I actually think there could be interesting extensions looking at derivative contracts of other sorts. I mean, we're using FX forwards, which are sort of a very pedestrian kind of derivative. But there may be, I don't even know if this makes to the FX options market these days or to other options markets that are connected to the FX options market or to other, say, country equity options. But I think there's a rich space to explore there and trying to better sort of formally separate the anticipatory the effects and sort of embedded expectations. We're sort of taking a first pass at it here. So a lot of our effort has been in just mapping out the likely linkages at all and establishing that they exist. But I think there's a great deal that could be done to refine that going forward. Yeah. I hope that answers your question.
I also have seen, I know that the IMF put out a report, maybe I think it's a paper too. So they are studying the physical impact on the equity markets So we're on currencies, they study on the equity market, and then they didn't find a lot of impacts or significant impacts in the equities. So during this time of period, during the bull markets. So yeah, I think there could be a difference in equities and FX market too.
Yeah, and slicing it by assets, because it's a bit circular, because we're saying the way to buy the country is to buy the currency. What are you buying in the country? I'm buying the equity. Oh, you're buying the equity. The equity earns half of its revenue in a multinational sense. So, I think there's also natural extensions of dividing this by asset class, because when you want to buy assets from a given country, well, the real estate's pretty bloody well stuck there. But it's not so clear about the equities. The bonds, the government bonds are pretty well stuck there. I mean, you could make arguments for the tax base on multinationals creating a connection. But in the equities in particular, it is the most thorny. And we have, I mean, this is unrelated to this, but other work, this is more the Ken Fruit side of our academic engagement. But we've seen relationships between cross-border equity flows and currency returns in other contexts. Those could be made more complicated, especially through the lens of transition risk, when you consider where companies earn their revenue and how that demand for that equity is actually about buying a stake in a multinational corporation versus buying a stake in a local corporation. So if you think about how in England, there's the broad market index and the local market index. What is it? The FTSE 100 is more international firms, and then I forget the name of the other one that's more local companies, and they have very different properties, because one of these indices is a set of multinational companies, and hence is maybe less related to sterling. The other one is much more about the UK economy, and thus it's perhaps more tightly located to sterling. So again, there are interesting entanglements that when you particularly go to the equity market, I think, or the corporate bond market, perhaps, that arise and will be, we haven't studied them, but I think they're ripe for study.
Cool. Yeah, thank you very much for the answer. It would be interesting to see also, like for example, spoke about equity markets, the stocks of insurance companies, how they are exposed to different countries who are more sensitive to these physical risks and some that are less, and see how these stocks performed depending on their sensitivity exposure.
No, that's a fascinating idea, because you could expect that a lot of this comes down to attention and understanding. I would expect that someone dedicated to investing in insurance companies would understand their book of business and its implicit exposures. So you might find that these things are priced efficiently within insurance firms and less efficiently in firms that are exposed more indirectly, or have call it a investing clientele that's less focused on those exposures. It's a great idea.
Okay, thank you. I think we are a little bit over time already, so I want to close the official part of the seminar. We can stay, if you're interested, you can stay in the talk. We have another, I think, 20 minutes where you can ask more questions, and we discuss a little bit more the interesting research you both showed us here. So thank you for your presentation, Stacie and Alexander, and thank you for the participants. Thank you for the questions. And yeah, we will stop recording, and yeah, see you next time. If you cannot stay, we will have another interesting paper by Jonathan Harris, investing in impact in general equilibrium, sorry. And yeah, see you next time, and take care.
Thank you.
Thank you for having us.
Thanks very much.